Please welcome Agca to the stage. He'll introduce his panelists, or they'll introduce each other. Enjoy.
Thank you. Yeah. Good morning, everyone. In today's volatile microenvironment, the portfolio risk management strategies has evolved from a defensive discipline to a strategic capability that can unlock alpha. So we have an exceptional panel that brings together the perspectives from the public market, the early stage, deep tech, and corporate investors. So let me just briefly introduce our panelists, and as I do, I'll ask them each of a question, but first let me introduce each of them. So first we have Jochen from the Earlybird. Then we have Philipp from EnBW. Oh no, sorry, Erik from EnBW, sorry. Yeah.
Not yet, maybe, Philipp.
So then we have Philipp from EIC. And we have Philippos from the Energy Revolution. So I'll start with Philipp. Yeah, please introduce yourself, and while you do, I'll ask you a question. Philipp, you bridge the public and private capital at the EIC fund. How does that dual perspective actually shape your approach?
Yes, thanks, Ige. Good morning, everyone. So I'm Philipp. I work for the European Investment Bank, and I'm leading a team that's in charge of the operations of the EIC fund. As a context, the EIC fund is a 100% public fund, so our only investor is the European Commission. We became, within the course of the last 5 years, I would say the largest and most active deep tech investor in Europe. So to date, we have around exactly 312 investments made, which equals 1.4 billion. Within the next 3 years, which is the remainder of the current investment horizon, we are looking to add another 200 to 300 portfolio companies, and the total amount that we expect to invest is around 5 billion. So this is obviously a huge amount of data and huge amount of information that we have. And so the job of my team is also to adopt a data-driven VC approach to the EIC fund, because we also want to become smart and not just saying, hey, we are the largest. So that's a little bit the goal and the context. And with regards to your question, yes, so we are a public investor. That means by statutes we are a co-investor. So we can invest up to 50% of the investment round. And for each investment, we would require a lead investor where to come up with 25% of the round. 25% remainder can be other investors, existing investors, whatever. What do we mean by a qualified lead investor? That is for us someone who has ideally a VC, can be a CVC, can be a corporate as well, but someone who has a track record and experience in the market, who can come up, with a valuation, with terms and conditions of the round that we can follow. Because again, we don't want to make the market, we want to follow the market. Yeah, at the beginning, this was very, very important for us. Now I think where we see a shift, as I just mentioned, we do have a relevant data set. So we know very well what's going on, at least in the deep tech segment in the market. So I would say we follow the market, but we have more, let's say, sophisticated discussions around terms and conditions, about valuations, together with the lead investor. But where we still strongly require lead investors, for example, is particularly about hands-on support for the companies, because that's not something we are built to give. And so I think this is how we try to bridge the public and the private sector.
Okay, thank you. And coming to you, Jochen. So Earlybird manages one of Europe's largest portfolios. Please mention about that. But an additional question, what keeps a CFO up at night?
Yeah, I mean, Earlybird is one of the oldest, or maybe the oldest German VC. So our portfolio contains roughly 60 active companies. Right now, it's quite fastly growing because our fund is investment phase. What keeps me up at night? It's well, there are different layers of risk. Yeah, so on one hand, we have the fund level. There is DPI keeps me up. Yeah, so exits, hopefully they're coming back. On the other hand, we have compliance, all those op risks that we also have to manage. It's like, handing in information, regulatory reporting, filling staying, well, fulfilling deadlines. This is something, and well, here mostly the people may interested in the portfolio. So we have a look at the numbers. My concern right now is reporting time to get the numbers. So there's always a tough reporting deadlines. Like mostly, the VCs have to report after 45 days. Our companies have 30 days to deliver. Some do not stay with that deadline, so we just have 1 or 2 days to get the numbers to update the valuation. This is operationally quite challenging, and the other part is what we see. There was a lack of exits, but before that lack there was a peak, and I've heard that some VCs already say they missed the slot there because the investment managers fell in love with the companies, even hire more TVPI, not DPI focused, and they all regret that now. That we really keep an eye on exit opportunities, exit plans, fund strategies. What is the DPI plan? We have high ambitions on DPI, but also what we see now, as Earlybird is growing, we get more contact to institutional investors, public investors, and DPI is not important for them, it's IRR. So and then the timing factor is even more important. So these are some of the things that keep me busy but not awake. So I'm quite a good sleeper.
Okay, nice to hear. So Erik, coming to you, EnBW operates at the intersection of the corporate venture and the energy transition. So it's a unique risk landscape actually. How does being a corporate VC differentiate your approach on the risk management?
Yes, so few sentences about our setup because it's quite important for that question. So we are the CVC from EnBW, EnBW New Ventures. We have a 100 million evergreen fund structure. We invest in European startups that make energy infrastructure digital, sustainable. So we have the strategy right in the investment focus. Our team is incentivized on financial return. That's quite important, I guess. So we aim for 2 goals. Firstly, financial return, financial performance as a fund, of course, and secondly, having some strategic impact on EnBW and leveraging that. I'll dive into that later as well. So what's the differences for our risk management, risk approach? It's an evergreen structure, so we are pretty flexible in timing, so we do not need to invest the full committed capital during the first 2 years or something like that. So timing is quite important for us, which also makes our capital allocation not for the first investment, but also for the follow-on investments quite interesting. And of course, we do have a strategic risk level additional to other classical VCs. Yeah? So it becomes quite interesting when it comes to risk and also having a single LP corporate in the background.
Okay, thank you. And lastly, Philippos, we'll go deeper in this in later on discussion, but Energy Revolution Ventures focuses on the deep tech infrastructure, arguably the highest risk and highest impact segment. So what can you say about the most overlooked risks in the deep tech investing?
Yeah, so perhaps just for a bit of context, so Energy Revolution Ventures is a very specialized energy tech focused VC, could probably assume that from the name. We have a core strength in electrochemical technologies. We invest at seed and Series A, and we invest along 4 verticals, so energy storage, renewable fuels, carbon capture, and advanced materials. Super specialized team. We have, as part of the core team, 3 professors, 7 PhDs, and 2 engineers, and we invest globally. And then we also have our own venture builder program called Proseminar, which essentially plays even earlier on, co-founding or supporting companies at the ideation or pre-seed stage. We've got our own lab space to actually help build out those technologies. So a bit of context to answer the question. Quite funny in that you say sort of very high risk. We don't like to make things easy for ourselves. Things that we think are often underestimated or often blindside investors within the space. Firstly, I would actually say commodity pricing. It has a massive impact. What do I mean? So things like the lithium price, natural gas, steel, hydrogen, vanadium. Whether we like it or not as an investor or founder, it actually impacts the businesses regardless. And it has a massive impact, either making the investment case better in some cases when the prices go down, which we saw, for instance, in lithium. The last few years, the price has been rock bottom, fantastic. But now, sort of a couple months ago, it jumped up by 30%, almost overnight. But it can also, it also distorts the investment. And then lastly, I'd probably say geopolitical risks. As a fund, you set out your thesis, your strategy right in the beginning, and then, for instance, the US might come along and change its policy on climate tech. Or there's suddenly a bit of a tariff war going on, or China says no more rare earth metals and minerals being sold. So there's restrictions on that, and that overnight can change the landscape. Yeah, so I'll leave it at that.
Okay, thank you very much. So let's dive into our first segment, and thank you, Philippos. Actually, I will follow up on that with Philipp. So, Philipp, starting with the geopolitical risks, because the EIC fund's mandate includes the strategic autonomy for Europe, the geopolitical risk dimension most VCs don't grapple with, except Philippos, I guess. So how do you stress test your portfolio companies against the scenarios like sudden export controls, supply chain disruptions, or shifts in industrial policy? And does this extra layer of risk analysis create a better outcomes or analysis paralysis?
Okay, so yeah, when it comes to the geopolitical risk here, I would say, first of all, yes, we do stress tests. They are fairly basic as part of our semi-annual valuation exercise. So this is very much straightforward. And because in that sense we have to do it. But I think it's, as what Philippos said, I mean, I would say from my point of view, the companies that we invest in, or startups general, geopolitical risks are not so much of relevance. This is more of an issue the bigger you are as a company. Let's think about what's happened now in Germany with Volkswagen, for example. I mean, that's an issue, and if Volkswagen is impacted, how, I mean, a smaller startup is indirectly probably impacted by that. I think what Philippos mentioned is quite interesting, because if you are a specialized fund in an area, you might have a specific impact in that. For us, I would say it's not really a main, let's say, risk. So we focus on it, but we don't invest too much time on that, because we don't think it's super relevant for let's say, our specific portfolio. We have other risks to worry about, so to speak.
Yeah, thank you for the systematic framework there, but let me add another dimension to that complexity. You said you follow on the market, but in our previous conversations, we mentioned about you're investing in pre-market or nascent investors too, because of your mandate. So where the product market is speculative, and you're doing it while trying to retain the companies in Europe. When US and UK markets offer faster paths to scale and liquidity most of the time. So that's a triple constraint if I see one. The foster innovation in undefined markets, keep strategic assets in Europe, and generate returns. So how do you risk weight these priorities when they conflict, and have there been any cases of this conflict happening before?
Yes. So that's a very tricky one, and I would say let's break it down first in, let's say, managing the risks that we have, and then I would take the exit part or the return part, I would take it separately. I think it's important to keep in mind that the EIC fund is a political instrument which is set up in order to achieve policy goals. Two of the policy goals that the fund is supposed to achieve, first of all, we need to foster and we need to keep innovation in Europe. That's one goal. The second goal is that we need to achieve sovereignty, independence in technological areas that are considered of strategic importance for the EU. I mean, you can think of it, quantum, space, semiconductors, medtech, biotech, whatever, that might be subject to change, but still, you know, those are the main goals. So what does it mean as a consequence for us on the investment side? First of all, and again, I'm not talking for the exit here yet, we need to ensure that the companies that we are a shareholder in, that they remain with the headquarter and with the IP in Europe. So it would be a problem for us if the company would move the headquarters to the US, of course, or if we have, let's say, a large percentage or let's say controlling stake of Chinese shareholders, not because they are evil, but just because it's outside the EU and this is an EU-based let's say program. That's one consequence. The other consequence, as you said, is that we invest in technologies at stages, let's say mostly Series A, but where we are, let's say, often years and couple of millions or tens of millions of more funding away of seeing any commercialization. So that's another risk we need to manage. And how do we manage it? So the first part, keeping the companies in Europe, we actually and a spoiler alert, I'm not paid for this advertisement, but we use heavily the cap table section in Vestberry to basically record and maintain all our cap tables from all our portfolio companies and to keep it updated, even if there are, let's say, funding rounds without our participation, just to be aware of the shareholder composition. The data is then already structured, so it allows us and our engineers to create what we have recently actually published. It's a so-called shareholder report, which basically gives us an update on a quarterly basis on the change of non-EU shareholders in a company. So let's say if suddenly we see an increase from 0 to, let's say, 5% or over 10 or over 20% in, let's say, non-foreign, non-EU or foreign investors, then we can look into this. Maybe we realize, oh, okay, it's a lot of Americans getting in there. We might need to watch out. I mean, again, the job of our team is just to provide the reporting. So what then happens with the insights, it's less of a fund topic, it's more of a policy topic. So the commission needs to then decide on what to do in such case. But this is one way of how we manage the risk. The other way how we manage the risk, I mean, we also make extensive use of Vestberry when it comes to the KPI reporting, both on what the companies report, but also what our investment officers report from the board meetings and so on, so that we can keep track of KPIs, whether they are on track with their milestones and so on. And also we have a co-investor tool where we basically try to find suitable investors for any given stage for any company and try to make the next funding round happen. So this is how we, in a nutshell, and just very focused, how we manage those risks. Now, just to finish up on the exit, so when it comes from the exit, I mean, we are an investor, it's taxpayers' money, and I mean, we need to deliver returns as well. So I would say we have to be pragmatic and not naive that the exit markets, we don't have a very good IPO market in Europe. Let's say that most of the buyers for our deep tech companies will most likely come from the US. So I think as an investor and as a shareholder, we would probably not say no to that. So, and we didn't say no to that when I look at past exits. So I think there we probably take a more pragmatic approach.
Okay, great to hear. So I'll come back to you, Jochen. Sorry. Let me shift to the operational side. As you said, Earlybird is one of the oldest and funds in Europe as is investing in the early stage. So as CFO, you're essentially the chief risk officer for the Earlybird portfolio. And what's the hierarchy of the risk you monitor? And has that changed meaningfully since 2002's market correction or the AI boom happening starting in 2024?
First of all, I have to say I joined Earlybird 2 years ago, so I wasn't there in 2022. And I'm lucky we have a CFO and a chief risk officer because we just became fully regulated. So I'm not a lonesome warrior on that, which is a good help. Yeah, the biggest risk, or the priority is that we identify the losers in the portfolio. That's our job. So the job of investment management is to find the winners, the outliers, and we have to identify the losers as soon as possible to avoid that we double down on the losers. I would say this is one of our the most important economical benefit that we can contribute. Yeah, so having a look at the management reports, the KPIs, developments, are pretty much like the benchmarking function that Vestberry is now introducing. We also have a look at the other classical tools to get a view on that. And yeah, this is economically, and the other things is really regulatory, which is kind of a burden for the natural VC investment manager. So it's not a natural fit having regulatory in VC. So this is something we try to explain. We try to help them to join the journey, and really that the company stays together. So we are not against them. We are there to help, to explain from culture-wise. And this is something we really made a turnaround in our company. So everyone knows we are there to find solutions, not to name or spotlight the problem. This is something from the culture I'm very focused on, that really, even though we're just the back office, that's when I started, we're only back office, we have to do the things that others don't want to do, because you have investor relational sales and you have investment managers, both external, visible, one's collecting the money, the other one invests the money, so they're kind of the scene people, and this is also some of an HR risk, but to really partnering on eye level with the other departments, this is very important for me on the other side.
Okay, great to hear. Erik, staying on the theme of risk hierarchies, the corporate VCs face a unique tension, the strategic alignment versus the financial discipline. So how does EnBW Ventures quantify strategic risk, meaning the danger that portfolio companies diverge from your core energy thesis, and how do you weight it against the traditional financial metrics?
Yes, I think it's very, very important that CVCs do corporate venture capital and not doing some venture building or venture clienting. So of course there can be the tension between the corporate strategy and the strategy of a startup or your CVC. I think that's naturally that happens. But I don't really see it, or we don't really see it as a trade-off between strategic alignment and financial performance, because the number one priority should be having some financial return. And the business model of a CVC only works, at least in our opinion, if financial return is number one priority. And this strategic risk you mentioned, of course, it's very negatively correlated risk, but it definitely offers some chances if you have a big corporate in the background. So there's huge knowledge flowing from the corporate to us, because EnBW has nearly 30,000 employees. So you will definitely find an expert for very sectoral specific topics, which we need to leverage, of course, as a CVC, and also in the other direction, right? We can deliver teams in the startups which think with a very entrepreneurial way, and we can also have some influence on midterm strategic developments, at least in some sectors. So I think it's rather a chance than a risk to have to be a CVC if you play it good. And EnBW can also be one of the first big clients for the startup. So that's of course the goal. To have EnBW delivering some six-figure contracts with one of our startups, which of course is represented in the valuation quite directly. And how we quantify this strategic risk, we do have a scoring system for valuing the potential strategic alignment between the corporate and the startup. So we have some factors like, is the product of the startup complementary to the product set up from EnBW, or how much volume we expect to be contractual set in terms of ARR, for example, between EnBW and the startup. But I think it's very, very, very important as a CVC that you don't really, or a startup doesn't really need to be strategically aligned. So if it's good for the startup to not have a contractual relationship with EnBW or get into exchanges with EnBW, we are quite happy to leave it that way. And then we don't constrain ourselves when it comes to capital allocation for future rounds on this factor. So if it works out, the startup is doing great, and the financial performance is really good, we are also happy to support the startup in the following rounds. I think that's quite a good weight on the financial performance part. But of course, we aim for having a real strategic impact as well.
Okay, nice to hear. And Philippos, for the last question of this segment, deep tech investment usually have long horizons where the capex requirements, with massive capex requirements. But in the meantime of the investment and in the portfolio, your thesis might change. So, but you, as a lead investor, there's a trap for you. Let's say you have identified elevated risk in a portfolio company that rationally suggests you shouldn't deploy more capital in the next round. But you're the lead, and if you don't follow on, you're essentially hanging a distressed asset sign on the portfolio company for entire market to see. Other investors will interpret your absence as a negative signal, probably most of the time, potentially creating a self-fulfilling prophecy where you have just written off your own investment by trying to be disciplined. So how do you navigate this game theory problem, and at what point does protecting your fund level returns justify the reputational damage to the portfolio company?
It's a very long question. So just to summarize, you're asking, how do we manage having gone into a portfolio company at a certain stage, and then instances where we might not necessarily follow on, and how do we manage the signals that gives out to the broader environment? Is that correct? Okay, brilliant. So I think to answer that question, there's a few fundamentals that maybe need to be brought to light. So one is different funds focus at different stages, and they specialize at different stages. So for instance, we specialize at seed and Series A, and our sweet spot is really seed. Why do we specialize in that stage? Because we feel that we are comfortable with the technologies we invest in at that stage, and the very strong technical bench we bring along with us to understand the fundamental technologies we're investing in. And that we're very honest about to the entire market. So for instance, if we invest in your company at the seed stage, you as a founder, was the company that we're investing in, are quite clear on why we're coming in and how far we can support you. We invest based on fundamentals, so the technology, the commercials, the market, the team, so on and so forth. So we're quite clear on that. So what happens when we don't necessarily follow on into another round? I mean, there are a few different scenarios here. One is that it's not necessarily the case that if we don't follow on, we're showing the entire market, listen, we have no confidence in this company. It could be that we just want to strategically focus on more seed stage companies and seed stage deals rather than putting our money into a follow-on round into the Series A. And we will be quite honest about that. Also, the market knows that we specialize at seed stage. So just being quite honest about where you play and why you play often is good enough not to have this sort of catastrophic effect on the company. And I think there was another question at the end, but I don't quite remember. Happy to answer it quickly or follow on, carry on.
Yeah, I was going to ask you about, have you found creative structures to continue signaling the sport while actually capping your exposure?
I mean, again, we specialize at filtering early stage technology companies. We don't specialize in helping companies scale to commercialization. We will help where we can. We have networks. We have a great LP base that's often very strategic to the companies we're investing in, and we will try and open as many doors as possible. I think is the honest answer to that question. Yeah.
Okay, great to hear. Before moving on to the second segment, I would ask our speakers to be a little bit more brief. We are hearing great insights here, but we have some time constraints. So I'll start with you, Erik. Let's get tactical. Walk us through a specific operational intervention that EnBW Ventures has deployed to de-risk a portfolio company.
Yeah, that's quite an interesting topic, especially in Germany, if you're tax transparent on how you get involved in other countries as well, get involved into operational stuff at the startup. But of course, we need to differ between de-risking or risk management on a fund level, as Jochen said earlier, and doing risk management at the startup level. What we can offer and what we do offer, we do not intervene too much. Of course, we think the startup, the founders know their company pretty well, or should know them, and should tackle the risks on themselves. And what we can offer are exchanges and a network, connections and all that. So some good example was a successful exchange between the debtor management of EnBW and a startup. We saw increasing receivables, and everyone who missed on some energy payment of you guys in the private sector as well knows that the debtor management from utilities is quite good. So it was a huge success that they talked to each other, and they were able to set up a new debtor management for the startup together, or at least delivering some information to them. So that was quite a successful and impactful. It's not an operational intervention, it was just exchanges, of course. Yeah, and on the fund side, on the capital allocation side, we like to allocate the capital on the winners as well and find the losers. And so for us, it's trying to quantify on a quarterly basis. We don't call it a risk because it's also, again, chances for us. But we do look at different factors on a quarterly basis, especially the team, of course, the management setup and so on. Traction is of course also hugely important. So we try to do our risk management on the fund level and allocate our capital for future rounds in the right way.
Okay. And Philippos, let's stay on capital allocation, but from a different angle. So Energy Revolution Ventures operates in a space where single asset risk can be existential. How do you construct a portfolio level diversification when each investment requires such a concentrated capital?
Again, we don't make it easy for ourselves. So for instance, when it comes to diversification, I think rule of thumb is spread your bets and you'll be safe. Invest in the S&P, for instance, rather than single individual bets. But when you're a specialist fund, it's a completely different take. We're super specialist. It's like a tip of the spear approach. And we invest in energy technologies. And in fact, even in the energy technology space, we're even more specialized. So the only specific verticals we invest in. I think it's important to sort of note that there are different forms of diversification. So for instance, even within the specialist space we invest in, there are ways to differentiate. There are companies, or there are sectors, or there are technologies that require a more capex heavy approach, or that require more money going forward, that definitely fit into the high capex bucket. But then very much so at the same token, there are others that don't. For instance, you can diversify based on business models. You can diversify based on sort of a picks and shovels approach rather than sort of a hard tech solution. And perhaps just as a very quick example of this is we've invested in a sort of a hydrogen company which manufactures PEM electrolyzers. For them to reach commercialization, they have to sell entire units of megawatt scale production of hydrogen, and each one of those units is in the millions to sort of get up and running. But at the same time, we've also invested in a sort of advanced battery diagnostics company that has this wonderful sort of sensor that sees inside batteries. And this company has these smaller boxes that can do that and that are much, much cheaper to deploy. So it's a nice diversification there in terms of CapEx models. But one thing I'll just finish off with is the rule of thumb is very much sort of the way I started, diversify and you'll be safe. But at the same time, if you want to properly ride the upside and the returns, you want to be there and stand next to your investments, the specific ones, when they do come right. And that's actually where your big venture returns come in. So that's our model, taking certain bets, calculated bets, and sitting alongside them and waiting for them to come up.
Okay, real nice to hear. Jochen, I'll continue with you. I want to explore the human side of the risk mitigation. So there is an inherent tension between a founder's growth ambitions and the CFO's risk parameters. So can you share an example where Earlybird had to enforce some kind of financial discipline on a portfolio company that wanted to grow at all costs, and how did that conversation go?
Yeah, actually, I'm in the same situation as Erik. So you have to see our fund more as a financial investor, like a financial holding instead of operational holding. So we're actually not allowed to a management board. We have that situation because we do not want to have that situation. It's tax purpose, but also we are totally convinced that we invest in founders which can run their own company. Of course, we advise on them. And sometimes there's tension. Also, there's tension between the LPs. You know, we had recently the discussion with a co-investor. It was the opposite. We were in for all growth, because there was a lot of cash in the company, and the other investor was more defense. He wasn't sure about the product. He was not convinced anymore. So there was more on shareholder level. There was a discussion, but that we really jump into the business decisions of the founders. It's something we do not do. You know, it's when they want to hear our advice. We have also a project where we facilitate. We have experienced other founders where we can connect them if they want to get the expertise on that. So we offer a lot of options, but in the end, it's their company, and they decide on the business. Even though when we are allowed to on the board, we give advice. But we do not actively jump in. We do not send any teams in there. We do not send finance teams there in that case, or we don't send any sales teams in that. There are funds in Germany that are doing that, but we are not. So we have to live with that we cannot decide.
And Philipp, lastly, coming back to you, the IC fund has one of Europe's largest and most diverse deep tech portfolios, which creates a unique asset for you that most VCs don't have, especially on the data side. The data set of comparable companies on the similar stages, often competing in overlapping spaces. So how do you leverage this cross-portfolio intelligence for risk management? And do you use it in your follow-on investments or new investments also?
Yes, it's a good one. And I think, first of all, you can call it, we use it for risk management, but we more use it to make ultimately better investment decisions and try to make the information available to our investment team. As you said, we have a relevant set and size of data, which means that we can use it for data-driven insights. And so we actually focus on our own data set, and because it's big enough, we don't need to focus so much on third-party data sources. So personally, we don't use a lot of Crunchbase or DROM and so on, simply because we focus on our own curated set of data. So this is what we focus on. But I think it's also important, before I can give some examples of what we actually do, to take one step back. What is required and how do you get there? And as a first step, what is required? I mean, you need to have a tech stack that is scalable, and you need to have processes and procedures in place which allow you to ensure the quality and consistency of the data throughout the whole data life cycle. So, and when we set this up, I would say around 2 years ago, with the first step of implementing Vestberry, we were compared to most of the funds here, also what I heard from the other discussions, I think we are in quite a, let's say, comfortable position, because we don't have to worry about the origination and sourcing part. This is all done via the EIC accelerator. So we can fully focus actually on the monitoring and the reporting and the insights part. So that was the first thing. we knew we have a significant sizable data set at the end. So as I mentioned, in 3 years' time, we're going to have around 600 portfolio companies. By the current plan for the investment period 2028 to 2035, looks like we're going to add at least 1,000 new portfolio companies. So that gives us value. And so we focus on that. So what do we do? To give a concrete example, we have a couple of months ago released our what we call a sector dashboard. It's a Power BI dashboard. And there basically our whole investment team can get into the sectors. You know, you want to know what did we do in quantum, you immediately see, okay, those are the companies we have invested in quantum, those are the amounts, that's the average round size, that's the average dilution, that's the entry level pre-money valuation we invested in per round, with a mean, with a lower end, with an upper end. Those are the investors we have co-invested within that space, how much funds have those companies, or how much funds have those companies raised since we invested. So it's a lot of good information, which allows us to be more, let's say, knowledgeable when we make new investment decisions. When, for example, we see that in the medtech sector, the average valuation, pre-money valuation of a medtech is 16 million, and suddenly we discuss at the investment committee a case where the lead investor says the company for a Series A, the company is worth 100 million pre-money. At least it will raise some questions, and we will discuss on the basis on that. So this is for the investment process. And now, as a next step, what we are looking at actually is to better identify the competitors that we have in the portfolio, and to link it with the KPIs that we collect via Vestberry, to basically see, for example, we have 5 companies, all of them wants to have a follow-on. The typical argument of the investment office as well, we invested, we have follow-on capacity, and there's a round coming. So let's follow on, you know, but let's look at them more closely. And then, for example, with the KPIs, we can see how many of those companies have actually already generated revenues, or, you know, different factors. We are not there yet, but this is a project for 2026. We are currently discussing on how to implement that, and those are 2 examples.
Okay, great. So because we don't have too much time, I'll just ask you some rapid questions, and whoever wants to answer, please go ahead. So from our speech, I can understand that the risk management mostly happens at the capital allocation level. So was there any time that you have failed to do a follow-on investment, and you were wrong on it, and you saw that as an anti-portfolio? Not, I guess not. So.
Yeah, of course there are. I think in every fund, if everyone would know how to allocate the capital in the most efficient way, everyone would be very successful. I think it's a very, very great question, and I think it's very easy to find losers and see some problems. And for the winners, maybe a lot of funds are still questioning. But I think you need to have the balls, right, to put in the money and allocate it if you believe in it. Yeah.
And lastly, because this is a data-driven conference, I would ask you if you could mandate one change to how VCs collect data or structure their operations to enable better risk management with that data, what would it be?
Maybe I take it. I think whenever we discuss our approach, I think what is highly underestimated actually, at least in our setup, again, we sometimes call ourselves a sausage factory, considering the amount of deals that we do. I mean, this year to date, we did 100 investments, right? So, and what is important, I mean, we have all those fancy, nice dashboards, but it's really the data, to have the data quality and the data consistency, and then to have the data in a structured way. And I think this is where it starts. And I mean, the way it works, it requires a team to go through the investment documents, you know, to check the price per share, you know, the shareholdings, all those nitty-gritty things to be correct at the base. And just to finish maybe on that, what we discussed with Erik, it even makes sense for, let's say, when you have a smaller portfolio, because the moment you invest, I mean, there is a lot of other events that are coming up, cap table related events, rounds where you don't participate, earnout clauses, you know, other commercial payments documents that you want to keep track of in order to make the most out of the data that you have. And automation can help, but it cannot replace the human actually going with a certain brain through those documents, you know, and make sure that everything is there. I think that's, from our view, one of the most important points.
Maybe to add on that, it's still that we get a lot of information out of documents like PDF documents or even Excel files. The e-invoice is for me kind of a game changer now. It's the first time you got a PDF document but attached also the data set. This makes my life easier, and I think we should enforce that to really get a contract set it up by lawyers, but also data set behind it, like cap tables, waterfalls, and all that. And sometimes this will also show how difficult, weird the rules in the contract are, because there's a lawyer setting up. We just had the waterfall. Yes, we have Series A class shares B and C, but if you have A class, please treat the C as A. And if you have B shares, then treat it as A. So that actually means you have share class AB, AC, AA, and you have a BC, BA, and all that. And we just read it and said, okay, guys, honestly, that's who should calculate that when the exit is there? Yeah, that's very difficult. So I would appreciate if everyone in the chain thinks about how to provide the data in the end, not via a scanned PDF document.
Okay, great. So we measured the measurement frameworks, the mitigation strategies, and the real-world interventions and emerging tools. So I would love to continue with the audience questions from now on. I think they will give you a microphone.
I have a question for Jochen. Finance, I think, typically most funds sort of plays defense and has to do back office, middle office, as you mentioned. Where have been the most tangible examples where you've sort of played offense or created DPI or created value for the investment team? Pre-investment, post-investment, doesn't matter.
So, so far I only participated in one exit. Yeah, so that was, but there we actively asked, okay, but does it make sense to do a follow-on investment, because we put the investment into relation to the whole fund. Can it be a fund returner? Can it be an outperformer? Or is it just blocking us from getting the money back? So switching the focus from the portfolio company, because it was an interesting investment case. Still then, there was a co-investor, a strategic one, so it totally makes sense. But we said, guys, but we only have then 5% left in a anyway small investment that is not a game changer. It doesn't move the needle in the end. So we should move the needle now. This was where we contributed to DPI. I wouldn't say we created any value, because as we are a financial investor, the value is created once we made the investment decision. So then we somehow rely on the performance of the founders, and when we do follow-on investments. But what we have now also established, we have something called let's call it exit committee, and this is where the chief risk officer and we take place, is exactly to get a neutral view on the company, because the job of the investment manager, and that's the value of the company, is that they think big, that they really want to conquer the world with every investment that they do. And this is kind of a character attitude, and it doesn't make sense to enforce them to switch that at any place, because they have to be like that. And maybe my nature is different, and the one from the chief risk officer. And then there's what I said before, communication on eye level, that they really listen to us, and we have also the power and the veto power. The chief risk officer anyway has a veto at any investment, but then we say, okay, guys, it's time to exit. It makes sense. Yeah, if you cannot convince me that it's really, for us, we call it DPI cases and TVPI cases. Yeah, bring the money back and conquer the world. Well, sky is the limit cases. So there we have to be crystal clear, and the most value is that we do ask the right questions and try to convince people to get or do not fall in love with the companies.
Hello. Okay, we're back.
Hello.
I missed the first few minutes of this panel, so I'm sorry for that. And probably I'm asking you a question that you guys already talk about. But Ege was like, rightfully so insisting on the portfolio side of things because this is the topic of the talk. And Philipp, this might not apply to you, so sorry for that. I'm curious to know how much of what you guys are talking about translates into what LP ask you. Because honestly, this is all cool and it's all like on managing a portfolio, but eventually, at least once a year, you need to go back to someone else and telling them, this is what we've been doing. And usually these guys come to you with specific questions, or maybe with no question, and you're just like proactively giving them some meat to think about. And I'm curious to know how much of what you're doing translates into what you tell these guys. And maybe the beautiful dashboard that you have where PPS and entry point and all that kind of stuff would be beautiful to give to your LPs. I don't know who are your LPs, by the way, but yeah, I guess that. So maybe that's a different story. But I'm actually curious to understand all this risk, portfolio risk management, mitigation strategy, call it whatever you feel like. That once a year thing. What is your LP reporting look like?
Because we already ran out of time, I kind of stop you. To answer your question, it depends on the LP. We have very different LPs, so we have high net worth individuals. They ask different questions. They're also interested in how the market is going, what they can do on their private level. So that they don't ask us for advice, but they transfer what they learn from us. Then we have family offices. They have different questions than financial institutions or insurance companies. So in the end, everything that we do, it costs money and it has to fulfill the LP requirements because they give me their money. It's not like buying a stock. So when you buy a stock, I give you the money for the stock, but I haven't paid anything into the company. They pay into the fund and they want their money back and we want to give them the money back. So this is, in the end, everything that we do is focusing on making our LPs happy. And this is where we 100% align with investor relations and with investment management. So this is our job, to make them happy. To produce good numbers, to sell a good fund, and to make it transparent over the time.
And maybe to add on this, again, our only investor is the European Commission, so we talk about taxpayers' money. The Ministry of Finance is behind. They are very curious to know what we are doing. So we actually have a fully automated report across what we are doing from our whole portfolio on a monthly basis. And then we do quarterly reports, but part of the reason why we are actually able to follow this data-driven approach is, first of all, the need for reporting. Right, and so the commission and the fund board is very supportive in supporting whatever we need to build or do to be able to provide that report. And then as a consequence of the reporting, I mean, we are able to get insights from the portfolio. So that's just from a taxpayer's point of view, might be relevant, that they care.
And I think it's all about transparency, right? Giving us much the information needed, of course, but it's also a transparency thing for us. Also, with one corporate as a LP, CVCs closing left and right in Europe at the moment. So of course, it's important to deliver transparency and show what is done and what value you bring to the table and what risks you mitigate. Yeah.
I was just going to sort of reiterate, as much as we'd like to make our LPs happy, and that is very much the goal, possibly at the end of the investment fund period or when the returns come in. Transparency is so important, and being honest. Sort of, we're speaking about data. Here is the data. It's not lying type thing. You will inevitably have some failures or some investments that are not going that well, and hopefully you'll have some that are absolutely hitting it out the park. But being transparent and honest about all of those is so very important. Otherwise, I mean, if I were in the LP shoes, I would really be questioning the honesty and the efficacy of that fund. It's just the reality of the game. It is venture capital after all.
Okay. Thank you very much. Since we're already over our time, I wouldn't ask you my last question, but please, our audience, you can just find them in the coffee break and ask them a question about their own LP and their funds risk management, meaning that the prolonged exit draws or LP funding crunches. They can tell you more about that in detail. And that's all the time we have. This has been an incredibly rich conversation. Thank you, Philipp, Jochen, Erik, and Philippos for their insights. And please join me in taking our panel.